you should always choose the higher?
Not necessarily. As long as they're both under 5.06,
Right.
the higher will be better. In fact, there's some very rare circumstances. I've talked to Jeff Birdsall at Reverse Vision about this. There are some circumstances where even if they're above 5.06, you want the higher one, depending on what the client wants. But generally, if you're at 5.06 or less, the higher expected rate will provide them better tenure and leases. Now, let me follow up by saying, some people say, well, they want a line of credit, so it doesn't matter. That's not true, because 20 years from now, when they convert that line of credit to a tenure, what expected rate do you think they're going to use? The one that was established at closing. And that's a little secret that most people don't know, is that your client 20 years down the road is going to want a higher expected rate because it converts them into higher payments, even then.
So again, you should always pick the higher margin, but keep it under the 5.06.
As long as both are below 5.06, the higher is going to be better. It's not going to, in fact, impact their principal limits, and it can only help them. So good follow-up questions. I'll take one more, and then we probably better move.
So it's like A and B. A, you have the two different options. You have the two different options that are based on the date of what the swap rates were, now and then.
Right.
And we don't have to worry, it's a control, it's pick one.
That's right.
And then the other hint, 2.1, is you can adjust the margin in the processing part with an LOE to do the same types of techniques that may, so it's not adjusting the margin at application, it's just, I got it right.
You summarized it perfectly. There are two different strategies here, and we kind of went into the second one briefly, but yes, the first one is you have the option between the first, or you can drop it to the second. The second example, you're right. You could technically change the lender margin, and compliance doesn't like that, but they will allow it if you have a good letter of explanation and the client has been explained how it benefits them. All right, let's move on to number 3. I know you guys who went through the NBS presentation I did last Thursday? Okay, good. So we only have a few. Good, then I'm not repeating a lot of information. I'm only going to go through 2 slides on this, but this can help you get some deals. By now, everybody knows that when a spouse is not on the reverse mortgage, they're technically a non-borrowing spouse. Okay, but did you know that there are 2 types? There are 2 types of non-borrowing spouses. When I was building this slide, my son came into the office and I said, hey, you know there's 2 types of non-borrowing spouses? Of course he doesn't care, he's 12. And he goes, yeah, there's male and female. No, that's not what I'm talking about, but it's a hilarious answer, so I had to write it into my notes. But no, we're talking about eligible and ineligible non-borrowing spouses. Let me give you a little background. I know I went through this on the Thursday session for those of you who went through this. In 2014, when they created the non-borrowing spouse regulations, they were under a lot of pressure because of the lawsuits with AARP, and they had to get stuff done quickly. They wrote the mortgagee letters, they released them, they updated the principal limit factors to go down to age 18 for a non-borrowing spouse, which we won't talk about. But they did it rather quickly, and the lenders came back and said, oh, wait a second. If the spouse is not occupying the property, why are we penalizing the borrower by reducing their principal limit? The spouse has no rights as a non-borrowing spouse in that situation. And the lenders were right, and HUD hadn't considered that what if they're in a nursing home? Maybe they're separated. Maybe they just choose to live in another state. Should it matter? No, because the non-borrowing spouse has no rights to stay in the property after the death of the borrower. And so they came back and said, we'll get it on our drafting table, and it took them about 6 or 8 months. I believe it was February of 2015. They said, all right, now you have 2 types of non-borrowing spouses. You have eligible. They generally occupy the home. They're protected by the due and payable provisions, which means when the borrower dies, the NBS stays or can stay if they jump through the right hoops. But you got to use their age. You got to use their age in the principal limit calculation. Now, when you call into the 1-800 numbers from TV and you're going to get a reverse mortgage, are they going to ask if they're eligible or ineligible? They don't know the difference. I know, because I know a lot of those guys. They're very quickly trying to get to the next call. You know what they ask? Are you married? Yes. What's their date of birth? Let me run some numbers. Here's your principal limit. Nah, it's not a good deal. And they dump the call. Is this an advantage for you guys that you know the difference between the two? I think so. So let's talk about ineligible. Ineligible non-borrowing spouses generally don't occupy the home. We don't need to talk about the generally. But they're not protected by the due and payable provisions, which means they don't get to stay in the home without the due and payable. And we don't have to use their age included in the principal limit calculation. So it is unlawful for you to make them ineligible. So consider that a warning as much as you'd like to, because I had a client the other day, age 75, married to 50. And my first thought was, Bill, are you and Sandy getting along? No. We're not going to encourage or talk to Bill about making her ineligible or vice versa. I had a 74 married to a 47 recently. And so you look at those situations. In fact, the client told me, I'm the only one on title, and he kind of insinuated, it's just me, it's just me, it's just me. And I didn't follow up with the question, well, are you married? Well, yeah, I am, but she's not on title. Well, I found that out an hour later. You know what that does to the client's principal limits? Yeah, I mean, I just spent an hour of my time talking to a client that I thought was single, okay, or possibly married, but married to someone their age. Okay, so if you can identify whether they're ineligible, that's great, but you don't ask, are you getting along, as much as you'd like to. By the way, you want to ask why they're getting the reverse. Maybe they're not getting along. Now, you didn't ask the question. You just said, why are you getting the reverse? Oh, well, because we're splitting up the estate because we're separated and we're going to get divorced. And how many of you have had those loans where they're doing it? Look at that. They're doing the loan because they're getting a divorce. They're splitting up the assets, right? And a reverse mortgage works very well for that. Ask the right questions, because the 1-800 numbers are not asking that question. Question.
I just did my first MBS in 8 years last year, and I was eligible. And I was surprised to learn that even under the new rules, they still take the spouse off the title.
Correct.
So that was a surprise to me. I thought somehow that the law was changed so they could be considered even though they're below the minimum age.
Even when this came out in the summer of 2014, there was some really poor training on it. They called the non-borrowing spouse a party to the loan and a co-borrower, non-borrowing co-borrower. Now, they're not a party to the loan in any way. And we covered a little bit of this on the Thursday session, that the whole reason this came about is because of one phrase in one statute that indicated the spouse of a borrower on a government-insured loan is considered a homeowner, in quotes. And that caused all kinds of legal problems. When you think about the thousands of pages that govern what we do, the stuff that Sharon and Cynthia have to know about, thousands of pages of regulations, and one phrase caused a massive lawsuit, 2 massive lawsuits suing HUD. And so ultimately, we had to determine some way to get around that statute. And the way they did it was they gave them some homeowner rights because they were considered a homeowner. That does not make them a party to the loan. And so to your point, they won't be on title, they won't be on the reverse mortgage, they're not a co-borrower. They only have one right. In fact, they don't have access to the line of credit. When the borrower dies, that line of credit dies too. The loan technically matures, it's just not due and payable yet. Question?
Just a quick question. I have a client who's married for 30 years and lives apart for 20 of them. They're still living apart, but he's done the loan in his name. So in essence, she would then be considered the owner.
That's right, non-occupancy. Yeah. Now, that's a touchy situation that we'll want to talk with the investor about to make sure that we know that it's kosher. Man, a lot of questions, yes.
I was going to say for Dan, he's not familiar with it. I didn't go to the estate planning or elder law attorney. They can set that up in the trust for the borrower and have a successor trustee so that it's not a probate incident.
Right. In fact, the non-borrowing spouse only has 90 days to put the home in their name, and sometimes that's very tricky to probate within 90 days. So to your point, that's a very efficient way to do it. HUD did not make the hoops very big to jump through. They made it hard. Yes, question?
Okay, so in the state of California, it's community property. Can you guys hear me? Okay. So state of California is community property.
Right.
And in this particular case, I get a lot of clients where they're separated. They're still married. They're separated. One lives out of the house, not on title, doesn't live in the house. My question is, do they still have to sign the application?
Yes,
Because it's community property.
I believe so.
Yes. Okay, that's the challenge I have.
I'm not going to put on
Because
on this
one,
slide, but
they don't want to know what they're doing. They're like, say they have both different houses, they live apart. One doesn't want to go to the other one, you know, to sign the application because he's doing a reverse mortgage.
right.
So that's my challenge. So there's no way going around that.
I don't know for certain, but
Can
we
you
look
check
into
for
that.
me? Because that I
Absolutely.
get that a lot.
Let's write a note to look up community property states and how that's impacted by the non-borrowing spouse regulations for non-occupants. And
They have to participate in the counseling process. They have to participate in the application process.
mhm. Marriage issues are painful.
There's no way. There's no way around that.
Um,
There's no way.
Hey, we had one more question, and then Sharon, we've got one more question, and we got to fly on to the next one. We've got 8 to get through, and this next one's big.
So we have common law marriage in Texas. In Texas, though, we don't have, you know, the non-borrowing spouse. We have the ineligible, but not the eligible. Have you heard anything through Normala or anything that, because I think it had to do with a lawsuit or something that was going on in Texas, and then once we had the financial assessments, that was put on the back burner. Is there anything that you have heard that we are going to be able to do that? Because I have 5 of them sitting on the fence right now because of this.
I don't know. On a state level, I just don't know. But we can look into it, and that's the kind of thing definitely that we want going to the desk. And once the desk gets it, then I get a chance to, or Sharon gets a chance to research that material. Okay. And so that's absolutely what we want to do. You know, let me take this moment also to commend the desk. Every time you ask questions to the desk, it's a documented question that we can go back to, and it's been a great resource for us. So let's click on to the next one. Oh, we got a knowledge check. Knowledge check. Now, we know that expected rates do not affect the compounding of the loan, right? They also don't affect the line of credit growth, right? So tell me, can somebody tell me what 3 items do expected rates impact? You got to say all 3. And what? Well, principal limit would be the same. Who is it, Sharon? Principal limit? Tenure? We got other questions. I'm going to give it out. To another one. And leases. Principal limit, monthly payments, and lease are impacted. Don't worry. We'll give this out. I know how much you guys love it. Shameless promotion of my book. All right, let's get to a big one. Okay, I think we're probably going to want to spend some time on here. I've spent a lot of time just kind of researching it. By the way, when we were talking next door, HECM ARMs are not Reg Z loans. That's good, right? That's very good, because we were over there talking about all kinds of Reg Z issues. We generally don't deal with that, and it's over. Faith, I had mentioned in that session 90% ARMs. We're well over 90% ARMs, right? I think we only do a couple fixed rate loans, which, by the way, are Reg Z loans. And that's why your origination fee goes to open mortgage, because you can't get dual comp. You can't get paid here and here on fixed rate HECMs, because those are Reg Z loans. So the regulations that we heard about there do apply to us on the fixed rate loans. The vast majority of our business is ARMs because it's an open line of credit. It opens up all kinds of financial planning advantages. The industry has shifted almost completely to HECM ARMs, which allows a lot of creativity for the way we price our loans. You can price your loan any way that makes sense for the client. You do not price your loans the way that makes sense for you. because the CFPB is going to look at that. And that's why I brought up the question. Eventually, the CFPB is going to look very closely at how you're pricing loans, not just from a comp standpoint, but also from a fair lending, fair housing, ECOA. Are you treating people differently? Disparate impact, disparate treatment? Yeah, we might have some problems there. Okay, so you need to have a type of pricing policy that you work with. And I know some of you are very consistent in the way you price loans, but your borrowers are going to have one of two objectives. They either want the lowest rate or they want the lowest cost. Now, sometimes they want both, and we're going to address that too. But we can give them the lowest margin. We go down to 2%, right? Next week, the lowest cost, well, we can go up to 3.375 and pay some lender fees and maybe eliminate the origination fee. So there are creative ways that you can price the loan to meet their objectives. Now, when meeting with financial planners, I want to eliminate the origination fee. That's often the largest fee. It depends on what the IMIP charges, right? 2.5 or 0.5. But in cases where they're borrowing a lot of money, well, the IMIP charge is massive. Let's eliminate the origination fee. And so you guys have your own pricing policies, and that's fine. But I wanted to talk about how you've got two dynamics going on. The client might want the lowest rate. They might want the lowest cost. But we need to ask those questions. What is your primary concern? Is your concern interest accrual because you're thinking about your heirs? Well, I want bequest value of my estate to my heirs. This is their inheritance, and I feel like I owe it to them, which I have a problem with. Okay, but that's a story for a different day. But if their primary concern is interest accrual, we can offer them a 2%. I'm going to charge an origination fee. But if their primary concern is the upfront costs, and maybe they're looking at this as a short-term measure, well, we can give them a higher rate, especially for the financial planning clients who want the line of credit growth to explode. And next week, we'll be able to go 3.375, and we'll be able to show them what happens over the next 20 years with your line of credit. So before I click to this next slide, because I don't know if the animation is timed correctly, anybody want to take a guess at what's the most popular HECM ARM lender margin at Open Mortgage? Wait, between January 1st of this year and March 19th, when Faith pulled the report. Now, Faith is ineligible. I'm sorry? 3.375? What is the most popular lender? What is it? 2.875. Okay? Do you think this might be important information for you guys to know at a sales summit? What are your peers doing? Okay? Now, I was curious. Now, I may be one of the few, but I'm curious. What are you guys pricing your loans at? Okay, right now you are. Yeah. Now, we had this conversation. I've talked to a few of you about how you price your loans. And what you find is, when this report was pulled, you're talking about a lot of January closings, right? Or January apps that were closing in February and maybe some in March. Through most of January, 2.875 was the highest lender margin you could charge and still keep them under 5.06 expected rate, right? We don't want to cross over that 5.06 mark. So you had a massive amount of loans that were closing between 2.75, 2.875, but you remember in late January, early February, swap rates dropped, which allowed us to charge higher lender margins, and you guys did. So when we pulled the later report, Faith said, you know what, we got a boatload of 3.25 closings coming up. And this histogram shifted up here. So you find that you guys are pricing your loans based on the swap rate, which is one of the reasons why I send a report out to you guys every Thursday night or Friday night. I'm glad. Now, some of you, it doesn't matter because you're pricing your loans in this area right here, and you're going to go up an eighth, you're going to go down an eighth, depending on what the client wants in the way of pricing. Some of you may be in competitive situations where they're borrowing large amounts of money and you need to shift that lower to make sure that you get the deal. But everybody's got their own pricing system. For me, I'd rather go with higher lender margins, wipe out the origination fee because it looks good, it looks great. Also, I like to throw down some lender credits because I want to start doing more volume, especially with the financial planners and the realtors that are going to also be looking at this. We had a question. Yes.
So you're working with a financial planner's client who wants to put the money and has no loan to pay off. He's going to let it grow in that line of credit. So you convince him the 3.25 margin is good. You're eliminating the origination fee.
Right.
What are you getting on the back end of that loan?
Yeah, and that's a big problem right now with the way the loans are priced from our investors. And that's something that's hotly debated right now at the national level with NRMLA, is investors do not incent you to do the proper thing in this case. When we've got a financial planning deal, I know some people are going to borrow the closing costs, and that's it. In fact, that brings us to the second point. Let me get to the next slide, and I think that's going to answer some of that question. It's a major problem with the way our loans are structured right now in trying to do what's best for the client, but also get paid. Okay? Issuers are in a different situation because a lot of issuers are going to pay based on max claim amount or principal limit, and they can do that because they're waiting 20 years for the borrower to draw $100,000. So that's probably more than you needed, but let's talk about what if the client wants both, especially in financial planning situations. Because I had a client several months ago who came to me based on a blog I had written about line of credit growth. She owned the home virtually outright. She was borrowing a little bit of money. She wasn't borrowing much, closing costs and a little bit of initial draw to pay off some consumer debt. And she said, my number one objective is I want that line of credit growth. I want to extend that out 20, 25 years. She's 62 years old, and she's looking at it, the line of credit growth, and it's impressive at 2.875, which, by the way, was the highest lender margin we could go at the time without a reduction in principal limit. She looked at it and said, this is awesome. Guess what? She got counseled. That's a problem because counselors don't understand what we're trying to accomplish. So she got counseled. She comes back and she says, well, the counselor says I'm getting screwed on the rate. Can you offer me a lower rate? And I said, well, wait a second. We talked about your plan. I'll show you what a 2% lender margin does to your line of credit over 20 or 30 years. I'll show it to you, and it's not pretty. She goes, well, that's what the counselor said. That's what I want. Okay, well, that's fine. I can give you a 2% margin. It doesn't really bother me from an investment standpoint. Remember, I get paid in two different ways. I'm not getting paid much over here anyway. I can give her a 2% margin. But then she says, you know what else the counselor told me? No origination fee, right? And that's when you walk away from the loan. And you can't be afraid to do that. And I said, you can't be afraid to explain to them, Roger, you know, when I meet with your clients, I hold two hands out. And I said, I can get paid by you, and I can get paid by an investor that sees a perceived value of that loan to them over the long haul. They expect you to hold that loan, and they're going to get interest over the life of the loan. Who do you want to pay me to do my job? Is it going to be you and an origination fee? And I can go lower on the rate. Or is it going to be the investor? And invariably, they're going to say, well, I want the investor to pay, right? Well, then I'm going to have to price that accordingly. And I have that frank conversation with the client. Now, I had that conversation with that client pre-counseling. When they came back from counseling, I said, well, what the counselor told you is that we're going to take away this, and we're going to take away this, and Dan's not worthy to get paid for all the work he's going to do over the next 3 or 4 weeks to get this loan closed. I said, that's what the counselor told you. Now, counselors often have that mindset, often a nonprofit mindset, and they hate the big lenders. I understand that because I've worked for one of the major counselors. And you can't be afraid to walk away. And by the way, as I walked away, I paused and I said, how much did you pay the counselor? $125? But you told me you were only on the phone for 35 minutes. If I had structured the deal the way the counselor wanted, I would be paying you a lot of money to get a reverse mortgage, and my family won't allow that. You know, open mortgage won't allow that. I'd be taking a loss on that deal. So what the counselor is saying is, oh, you can't negotiate $125 for 30 minutes, but you can negotiate Dan's salary. And so you can't be afraid to walk away from those deals. So we can price our loans excuse me, we can price our loans creatively, but have the frank conversation with the client about how we get paid. You don't have to go into a lot of detail on it, but you have to say, I don't really want you to pay me to do my job. So I tend to price my loans a little bit higher. And you guys can take this what you want from this. You guys need to have your own pricing situations. I know we're running out of time, so we got to fly through this next one. I can take that after though. All right, most of you know at this point that you can time your closings to give them more money, right? 6 months, right? You take a look at the birth date. Okay, you close within 6 months of the next birth date. FHA rounds to the nearest age. Nearest age. Reverse Vision also calls it nearest age. Oh, that's great. If you monitor their birth date and you have that conversation with the client, and by the way, every year they get a nice little bump. So it's very important to time your closings based on the 6 month rule. You're going to get an extra 0.6% for your younger borrowers. Hey, you get up between 89 and 90, you get a 1.1% increase. What kind of increase do you get going from age 90 to 91? Who said that? Nothing. That's right, 0. Because principal limit factors flatten out or flatline. We're not supposed to use the term flatline when talking to seniors, okay? But it maxes out. Let's use the term max out. And so every year, they're going to get more money if you strategically time your closings. However, the support desk still gets calls consistently. Calls like, my principal limit went down and I don't know why. And when that call came in, it actually came to me. I think Cynthia was out of town at the time. The call came in to me and I said, oh, because the borrower has a November birth date. Loan officer said, what? I said, your borrower, your youngest borrower has a November birth date. He goes, how the heck did you know that? That's 6 months from your closing date. The conversation was about 5 minutes long. You may remember this conversation, but I said, somebody changed the closing date. Reverse Vision sets it out 60 days. Can we close in under 60 days? All day long. Okay, so when your processor or underwriter or the closer changes the closing date up, there's a good chance you just reduced your principal limit. So the reaction was hilarious. I don't remember who was on the call that day, but we've had that call multiple times. You need to know, you need to strategically time your closings. We had a complaint. Hey, competitors are offering higher principal limits than us. No, they're not. No, they're not. It takes them longer to close a loan. So if they set the closing date out 90 days or 120 days, yeah, there's a pretty good chance that the borrower is going to get more money simply because we close faster than they do. So always be thinking. I want to briefly tell you a story about when I learned this lesson the hard way. Client was short to close. Devastating. She's just really upset. She's short to close by just a little bit. She had a garage sale. She sold personal items. She scrounged together as much money as she could. And then the closing got delayed. And now she's in tears again. This was not an open mortgage, by the way. This is a generation mortgage. The closing got delayed. And of course, I had to break her the bad news. And then I looked at her in the system. Wait a second. You're getting $1,500 at closing? No, you were short to close just 2 days ago. When you change that closing date and you get within that 6 months, all of a sudden, she didn't have to have a garage sale and sell personal items. Wake-up call for me. That was one of my first loans, and I've never forgotten it. I've never forgotten that because I was crying with the borrower was crying with their family members, and then all of a sudden, she's got mixed emotions. Now she's thrilled, of course, that she's getting money at closing, but we didn't have to put her through that mess. Always monitor your closing dates. Now, this is a conversation I had with a client recently. Ma'am, I'd love to close your loan in mid-May, but if you want to wait till the end of the month, I can offer you an additional $1,700. Would that help? Yeah, even if it's in a line of credit? Yeah, exactly. Yeah, let's strategically close it. And I put in the notes. I sent this one to my LO, Carol, and said, Carol, do not close this loan before May 27th, or they're going to get less money. Okay, so that's a conversation you can have. Now, how many of you knew that you can also strategically time your closings to benefit the client by closing the day after their birthday? Anybody? A couple of you? How many of you read it in the newsletter? Okay, we did put this in the newsletter. It's called a happy birthday strategy. And most people don't know there's a little happy birthday strategy because nearest age is only used for principal limits. Well, it's used for a couple more things too. Actual age is used for leases. Brilliant, right? Now you can close the day after their birthday and have a smaller Lisa, sometimes. I'm going to give you an example. Client has property charges of $5,000 annually. Before their 63rd birthday, that equates to $71,962 they got to contribute out of their principal limit. It's a lot of money. Yeah, it's a slight reduction. The day after, 2 days later, saved them $1,767 in. That might get you a deal over a client, over a competitor. Okay, so that's the happy birthday strategy. So apparently that's new to everybody here. Hopefully that's going to help you get a couple loans. The moment there's a LIA, closing that day after their birthday. Now, that doesn't always work. If you look at the life expectancy tables, age 62 to 63 has a change in life expectancy. 65 to 66 does not, because it's based on years and it's rounded and then multiplied by 12. That's more than you guys wanted. Just know that it doesn't always work. There are certain ages where it's huge. It's huge, okay? But just change the closing date in the system to the day after their birthday. It's a very easy change. Type in an adjusted for a few days and see if it works. Yes? Well, yeah, I would think it would be. I haven't run the analytics on that, but yeah, I imagine it would be, because you're compressing that life expectancy very rapidly in those later years. So I think that's a really good point. And you know, that might be a good study. One pager. That's more than you guys want. All right, let's move on. I know we're running out of time. Submit your loans to Fast Track. I know we wanted to get to this one. How many minutes do I have? 5? Okay. Submit your loans for Fast Track. I know we've been talking about this a little bit, but we've been working on a situation where we can fund loans faster. Do you think that would help you? Yes? Okay. If you can fund loans faster and you get those out of your pipeline and start working on building more business, do you think that would help? By the way, for Fast Track, all reverse vision screens need to be complete, and all pages of the application and disclosures are signed and dated, and credit's been pulled and analyzed, and we verify that all traditional documentation, property docs, financial assessment docs are collected. Then underwriting just clicks a button, right? Now it's fast tracked. And the form that's going to print out in reverse vision looks just like that. Now, you're missing one item? Get that item. Then submit it to fast track. Don't submit it through traditional means and wait for that. Get that one last item and get your loan through faster.
And you get Sharon as your underwriter.
Clarification on that. Are we submitting to the processor at that point with this form, and then somehow it's going to be checked as a fast track loan, and it will.
The processor will still check to make sure everything's there. And if everything's there, then they're going to go ahead and order a appraisal and title, and go ahead and run the documents that they need, FHA case number, connection docs, submit everything to underwriting at that point, except title and appraisal and payoff. So it's going to take a lot longer.
So you just went to the front of the line because of this form alone. Okay. Well, this is going to be the first page that'll print out. And it's going through without those items, so it's basically getting bumped to the front of the line and getting an underwriting review. Yep. And this is just rolled out this week, guys. So we're going to have some additional communication for you. I just wanted to let you know that I think this would get you, yeah, this would get you a few more loans. Yeah, let's get it through the pipeline a little bit faster. And you know what? Your referral partners are going to love this, but we're going to do a quick knowledge check. Uh-oh. Your Smith loan is in processing, and suddenly you notice the principal limit amount has dropped by almost 1%. What's the cause of the reduction? Yes. The closing date was changed. All right, the closing date was changed. Consider this. We're setting out 60 days. We used to have this problem in Generation Mortgage where we set it out 30 days. Okay? You got 1/12 chance that a competitor is beating you with principal limit calculations. All right. Last one, we'll just go through this very quickly. Sell the advantages of the prepayment. You know, everybody seems to think that the major advantage of a reverse mortgage is you don't have to make payments as long as you have this loan. Now, that's a great advantage from a cash flow standpoint, but think about from a financial planning standpoint. There is such a massive advantage. When a borrower pays $10,000, I know most aren't going to pay on a monthly basis. They'll pay quarterly or annually, or they'll liquidate an investment and they'll pay down their loan balance. When they paid $10,000 towards their loan balance decreases by $10,000, the line of credit increases by $10,000. I know some people say you can't say dollar for dollar because the statement's going to be off by the end of the month. On the moment in the system that you make that payment, that statement right there is true.
Dan,
Yes.
I read an article recently by a financial planner who said that he didn't understand why anyone who was over 62 with a mortgage didn't just have it reverse. Because it's kind of like the new version of the option arm without all the ugliness, you know?
Yeah.
Make a payment or don't.
Yeah, you have the option. It's going to help you either way. By the way, I know a lot of people challenge us on this. So let me talk just briefly about the calculation. This is assuming no set-asides, repair set-asides, life expectancy set-asides, servicing set-asides, which used to be very popular, because the formula gets very long when you start adding in other factors. For the majority of our loans, this formula holds true. The line of credit at any given time is what you can borrow minus what you have borrowed. If I subtract $10,000 from the UPB, the line of credit goes up $10,000. That's the easiest way to explain it. We've got a couple different ways using a seesaw. Okay, you've borrowed this amount of money. Here's your line of credit. You make a payment, and it does this. You make another payment, it does this. And ultimately, we want them to have a line of credit because that is about sustainability. And to your point, I think people at 62 and older, especially those with about 5 years left in the workforce that have a forward mortgage, ought to flip that over to a reverse mortgage and make the same payments. And we can sell that. We can sell that. And that is going to get you a few more loans if you fully understand this concept. Yes, question.
I forget when this was, maybe about a month ago or so, Joe Morris told us where there was a call that if a client prepays the loan more than a significant amount, they're going to collect their cash.
And I've got some clarification on that, and that's worthy of a one-pager. I know it's on my list to make sure that we understand. I know Joe's asked for it and Sharon's asked for it. Clarification on what the lenders require, and some of it's at 10% of the principal limit. And when you make monthly payments or quarterly payments, it's not an issue. We had a couple situations recently where the loan originator would call me and say, do you see this as a perceived issue with the investor? We'll want to look at that. The one concern I had with one of my clients is he has an investment property on the market. And I said, sir, what are you going to do when that property sells? And I wanted to know, I don't want to get hit because I'm already offering lender credits. I could take a loss on this loan. And so you do need to ask the question, do you have any other investments you're planning on liquidating? And he has the house on the market. He's going to net $400,000. Are you going to pay down the loan balance? Oh, no, I've got other things earmarked for that. And I said, because I could get hurt. And you can have that frank conversation with the client. Is the investor is assuming you're going to hold this loan in its present case, minus some prepayments on a monthly basis. But if you make a very large deposit to reduce your loan balance, that could really hurt us as loan originators. So we'll get some clarification on that. It's on the docket.
The flip side of that, though, is that we can get hurt like that, but if the borrower at close took nothing and then a month later took a couple $100,000, you don't see any of that.
Yeah, and the issuer makes money and doesn't have to pay a loan originator to do it. They securitize those tails. Now, I've been told when those are called tails, when after closing someone draws money and they securitize that. They put those tails in a pool of millions of dollars, and they don't have to pay an originator. And to your point, it doesn't seem fair to the originator, but we have compensation issues with that. It's what? No. There are risks associated with it, and they want to know what the intention was. I know some lenders will investigate to find out whether the loan originator encouraged them to borrow more money than they needed. In that case, you can document that, but we'll get clarification on the recapture. Okay. Well, we'll discuss it with Joe, and we'll get some clarification because each lender actually has slightly different guidelines. I'm going to go through the last one very quickly. Overfunding the purchase. We're going to talk a little bit about hecking for purchase. Guys, if you tell the client they have two options, one option is to buy the home in cash, which many of them are. They're selling one home and buying another in cash. And then we come in and we say, but why don't you leverage all the money? And by the way, you're going to pay 2.5% to the federal government. We need to give them a middle ground. Yeah, they can buy the home in the cash with needs, with a hecking for purchase. Option 3, just use 60% of your hecking proceeds. My job with this presentation is not to show you how to maximize what you get compensated on each loan. My job is to show you how to fund more loans. That was the title of the presentation, right? You can fund more loans this way. You can help more clients this way. Sure, you're going to take a hit in income, potentially. You can offset that with some origination charges. But who wants to pay 2.5% to the federal government to do a hecking for purchase? Yeah, I know some of you are doing this consistently, overfunding the purchase now, and it's a common strategy that if you know how to do this, you can give them a middle ground. Right. Okay. So they want the additional 40% as a line of credit and watch it grow. Sell this. Sell this all day long. The hecking for purchase. Consider overfunding the purchase to reduce their insurance premium from 2.5 down to 0.5, establish a 40% of their principal limit in a line of credit that's untouchable for a year. That's a great combination of purchasing a home, the realtor's happy, the financial planner's happy, right? Right. By the way, investing more money in the home than necessary, it sounds kind of bad until you see what the result is. Reduction in IMIP, established line of credit, low initial mortgage balance, which a lot of them are concerned about. Last question. Yes, thank you. ARM products only.